Welcome to the deep dive. Today, we're really getting into the weeds with Motilal Oswal Financial Services, MOFSL. Their latest financials are, well, quite something, a real study in extremes. Our mission here is to unpack this dual engine model they have and figure out a major paradox in their recent earnings report.
Yeah, paradox is the right word. It's a bit baffling, actually. You see this headline. Highest ever quarterly operating profit. Fantastic, right? But then the consolidated net profit just collapses, down 68% year on year in Q2 FY26. So how can you have both? Record operations and a profit crash. That's what we need to solve.
Okay, so it must come down to how the company is structured. Can you walk us through these two engines?
Right, so think of MOFSL having two main parts. Engine #1 is what you call the core operating businesses. These are the fee-earning units, things like asset management, wealth management, broking, generally more predictable stuff. Then you have Engine #2. This is their proprietary treasury investments. Basically, they're actively investing the firm's own capital in the markets.
Ah, I see.
And the Q2 results really highlight the difference, don't they? The operating profit after tax, PAT, from Engine #1, that was a record, 500, 400 looks really healthy. But the bottom line, the consolidated PAT was way lower, just $362, 402 Suncor. That's a gap of nearly, what, $200 core in 1 quarter? That's significant.
Exactly. And that gap, that roughly 100 and 152 crore difference, that's all down to Engine #2, the Treasury book. It appears to have booked a pretty substantial net loss in that quarter. And the volatility is, frankly, staggering. Compared to the prior year, that Treasury performance represents something like a 769 9-hour core negative swing. It completely derailed the consolidated earnings picture.
Wow. So your take then is that for anyone trying to understand the real health of the business,
Yeah,
you almost have to ignore the consolidated number and just look at the operating PAT.
pretty much. The operating PAT shows the underlying strength of the fee businesses. The consolidated P&L, it's kind of a black box, honestly. It's totally subject to the swings of whatever bets they're making with their own capital in the Treasury book. Okay, but hang on. If that Treasury part, Engine #2, causes so much volatility, why keep it, or at least why operate it so aggressively? Doesn't it undermine the stability they're building in Engine #1?
Well, that's the billion-dollar question, isn't it? It absolutely introduces instability. But we do need to look at what is working well within Engine #1, particularly the annuity businesses, asset management, and private wealth. That's the real growth story here.
Right, and this is where it gets interesting for the long term, yeah. Because these businesses seem perfectly placed to benefit from India's whole financialization of savings mega trend. I mean, the numbers back it up. Asset management policy up 46% year on year. SIP inflows soaring 2.2 times year over year. That's serious momentum.
Huge momentum. But, and it's a big but, there are drags pulling the other way. First, look at the legacy broking business. Profits there actually declined 24% year over year. That idea of an advice mode, it seems to be crumbling against the zero-cost guys like Zerota and Grow. It's a tough structural shift.
Then the other drag you mentioned, the housing finance arm, the HFC. It's just, well, it's a capital sink. It's generating a return on equity, ROE, of maybe 7%. That's way below the other parts of the business. It's arguably value destructive compared to where else they could deploy that capital. It really dilutes the overall picture.
Okay, so let's get to the bottom line. Someone asks, is MOFSL a lifetime investment, buy and hold forever? What's the verdict?
Direct answer, no. Not right now, anyway.
Yeah.
A lifetime investment needs predictability, stable earnings growth. MOFSL's consolidated earnings are fundamentally unpredictable because of that treasury engine.
So it's not a straightforward buy and forget. What's the recommendation then?
The analysis suggests a BUY, but specifically as a sum of the parts play, an SOTP value play. You're essentially betting on future changes, on catalysts that could unlock value.
Right, betting on restructuring. What are the key catalysts we need to see? Two main things, really. First, and this seems quite probable, is the sale of that low-return housing finance business. Selling the HFC could free up somewhere between, say, $3,600 to $5,002 crore of capital. That's significant. Second, and this is more of a strategic hope, is the eventual spin-off of the good bits, separating the high-growth asset management and wealth businesses from the volatile treasury and the declining legacy broker.
Got it. So to recap for everyone listening, buying MOFSL today means you're buying this kind of mixed bag. You get a high-growth asset manager, a broker facing structural decline, and this unpredictable proprietary trading desk, all bundled together.
Precisely. Which leads us to a final thought, maybe a provocative one for you to consider. Given this extreme volatility and the active management of that big treasury book, does it really represent management having skin in the game alongside shareholders? Or does it actually create a fundamental conflict, a principal agent problem for public investors who are just looking for stable fee-based growth. Something to think about.